And I heard that they're out. So one of the reasons which U.S. Mint is not producing a lot of Eagles right now is because their supply had been run dry because their supplier basically was feeding it to the retail end of the market or feeding it.
Welcome to Gold Silver Pros.
Hi, everyone. This is Rob Kientz with GoldSilverPros.com. This is your weekly market wrap-up for the week ending November 4th, 2022. You guys will see this on the 6th. This is done about 2 p.m. in the afternoon. So all prices that I quote will be as of that time. We have a lot to talk about this week. I think there's been a lot of movement in the gold and silver markets, and we'll get into that. But before we do, I want to talk about the economy and some of the major economic data points that we saw this past week. As I warned you guys last week, the big economic data point we really wanted to see were the payroll situation, so we'll get right into it. First Friday of every month, we get the non-farm payrolls. It might be the single biggest data point that most people look at in terms of economic health, because payrolls lead to consumer spending, and consumer spending is about 3/4 of the economy. So unemployment and the payrolls are a big deal. As of today, the payroll increased last month for non-farm payrolls was 315,000. For this month, economists polled thought we would get 205,000, expecting much more bearish than what we had last month. We ended up with somewhere in the middle, 261,000. So it's a little bit better than what economists thought, not quite as good as last month. How do we interpret that? Well, the markets are up and down. As I'm looking right now, the Dow Jones is up 34 points, but it was up 34 and then it was down 87. And now it's back up 34. So it's fluctuating back and forth. The S&P is up 3 points, both up about 0.1 or 0.11%. NASDAQ is still down because the FANGs have sold off, and the FANGs are down about 50% from their highs. So NASDAQ's not doing well. The Russell 2000, which are the small caps, is also down 0.4%. NASDAQ down 0.2%. Overall volatility as measured by the VIX is down a little bit. So I think traders are content with what's going on in the payroll part of the economy. The number's not quite as good as last month, but better than expected means that we are decelerating a little bit on job growth, but it's still positive, which overall is good for the economy. The Chicago PMI Purchasing Manager Index is below 50. It's at a 45.2. It's below the forecast of 47. It just means the purchasing managers do not expect growth in the near term. The S&P U.S. Manufacturing PMI is at 50.4. That's a final revised number. It's slightly in the positive range. Anything over 50 on that's considered positive. The ISM Manufacturing Index is 50.2%. Those seem to agree. Job openings are robust at 10.7 million, although we do have 4.1 million quits. Motor vehicle sales were higher than expected at 15.8 million. That's a very healthy number. And overall, the economy seems to have recovered a little bit, since the last quarter. Some of the deceleration in the economy, not quite as bad in terms of a little bit of the payroll and a little bit of the spending, although it's not super positive either. Next week's, what we're going to look at is consumer credit. How are people spending and how much are they putting on credit? Because you look at spending, if more of it's going on credit, that means more debt coming in the consumer. It means they're not quite as healthy as we want them to be. We'll also have core CPI month over month and initial jobless claims and consumer sentiment. We'll look at that in next week's report. Overall, at the time of this report, gold is doing well. It's up to 2.71%. That's up $44.15 to $1674.13. Silver is up 6.79%, doing better at $20.78. We're going to do a share screen real quick, and we're going to take a look at what's going on in the gold and silver markets. Here we have gold on the CME group, and as we can see by looking at the volume and open interest, that we've had a healthy amount of volume of trading lately. It's up above its normal number. And what's going on with that market? Well, December is a dominant contract. Remember, this is futures trading that determines the current spot price. So we always look at the next dated month for the derivative market to see where the trading is, because they're trading futures. They're trading what they think gold is going to do in December. The open interest was 348,000, which was healthy. They had a very high exchange for physical number. This is something I wanted to point out. 11,190. And usually what this is people going from the American market over to the London market, either to get exposure to price differences or to get physical that's not available. This is a pretty big indicator that gold may not be quite as liquid on the American exchange, or somebody sees something with the pricing between COMEX and London and they're taking an arbitrage opportunity or a trade opportunity. Let's look at the settlements to see where the pricing action was. We've got preliminary data for Friday. You can see here, preliminary for Friday. So it's not the ending day for Friday, but we're going to look at it. December is a dominant contract, so we're going to highlight that line. The estimated volume of 140,206 is nice and healthy. It's settled up $45 so far on the day to average 1676. If we go back a day and look at Thursday's data, and we look at the December contract, once again, we look at the volume 256,028. That's healthy. Down $19 to 1630.90. This is how you can determine the spot price, is looking at the day-to-day settlement changes on the CME group for the derivative trading in gold as of right now, the December contract. That's how spot price is determined. As of Wednesday, this is Wednesday's data, it settled at an average of 1650 on the contracts, 222,000. That tells you what went on. What happened to the gold in the physical? Well, you look at COMEX, it was bleeding. COMEX is down about 3 million ounces over the last 4 weeks. 4 weeks, all the categories added together, down about 3 million ounces. Overall, the rest of the sector is down about 644,000 ounces, and this is the London market. Some of this ETF gold here that we see in this part of the table is held in New York or other places. The majority of it's held in London, so this is a good London proxy for what goes on, and they're down as well. So gold is coming off. And if you look specifically at the biggest London ETF, which is GLD, and we click on that chart right there, we'll get a little bit of a runoff. So still healthy gold stocks in London, although it's coming down. Let's take a look now at silver. So if we go over to volume and open interest on the CME Group's website, again, more volume going on in silver. People are getting ready for the end of year trade and they're taking positions. That's what that means. December is also the dominant contract for silver futures trading, and we want to look at what's happened. At close, 103,000 open interest. We had EFP of 675 contracts of 5,000 ounce silver, meaning people are either taking delivery from London or they're playing price arbitrage between the two markets. Overall, looks like fairly healthy numbers. This is early Friday. Let's go back and look at the settlements. On the early Friday data for the December contract, 41,644 volume, up $1.35 on the day so far to settle at 27.84 as the spot price, or close to the spot price. Thursday's data, December contract, estimated volume 72,300, closed contracts down 16 cents to close at 19,430. The reason I show you all this data is to point out this is where spot price is determined, and it's not on physical delivery. This has to do in the paper. How do I know it's not a physical delivery? Because you go back to this chart on volume and OI, and you look at the deliveries, and it's 63 so far for Friday, not a lot. Or Thursday, I'm sorry, Wednesday, there were 7. Tuesday, there were 73. Out of all of these contracts, 105,000. So it's not even a percent, which is delivered. So that just tells you the spot price, not the physical deliveries. Looking over at the physical positioning or the flows of silver, the top 3 lines are COMEX. This is the US market. We're down, I would say, about 26 million ounces over the last 4 weeks in COMEX. COMEX has bled 26 million ounces total across all of its categories, registered and eligible. If we want to look at what's going on in London, predominantly these are London. You see also that we have lost some as well, but net we've gained. So there's more silver now pouring into SLV after we saw that silver being withdrawn from SLV for a very long time. It appears people want to reinvest in SLV, and you can see the slight uptick. Now, it doesn't account for all the silver that came out of SLV since Silver Squeeze in January and February of last year, but it is a nice little uptick, so some silver starting to come back in. So a little bit more silver liquidity going to the London market, a lot of it coming out of the Western market. It means net silver's flowing from the United States to London and to other markets, net. Going to the Commitment of Traders report, you guys are familiar with this because it tells us from the weeks prior how the traders were positioning on the market, which tells us how the prices will go. All of this data, this is aggregate data, gets broken down into pieces in this report, at least broken up into reportable positions by group. Those groups are producer merchants, swap dealers, managed money, other reportables, and non-reportables. We typically look at silver and gold, so let's look at silver. Now, this is as of October 25th, 2022. This is in arrears or a backward-facing report. So what we see in this data tells us what will happen in the markets here, because this settlement data occurred a week ago, and this is a result of it that we're seeing on the market. So this is rear looking at what happened in the last week prior to this past week. The producer merchants are net short. That's normal in silver because they're protecting their downward price risk for the people that produce it. Let's say your assumption is $20 silver, it goes down to 19. You're a producer, you're a miner, you put a short position on, so that if it goes down, you make money on the short position to offset your loss in the actual physical price that you get for it. Swap dealers traditionally are the smart money. They have net added about 2,100 to their long position, 1,800 outright, and then dropping 309 shorts. So they've continued to go net long. Those are the sharps, and I think the smart money in silver, predicting silver will go up. We look at the managed money, which are like the financial positions. It's a very big and liquid market, of which a very small percentage of what they invest in goes to the precious metals, and therefore they're usually on the bad side of the trade typically, and not the smartest money in this particular market. And therefore, they are net short, meaning I still expect the swap dealers to make money by going long. The other reportables are net long, although they did add 1,921 short contracts, so they're not as net long as they were before. I find this highly interesting. Why would wealthy family offices and wealthy individuals go net short on silver? What do they know that we don't know? I'm going to follow this over the next couple of weeks and see if some of the singular smart money and family office smart money in the market, what they're doing. Moving on to gold. This is now gold. And again, as of October 25th, 2022, from the CFTC, as you can see right here in the URL bar, and on the COT report, we see some interesting stuff happening. The producer merchants have gone more long by a factor of about 5,000 something about 5,100 contracts, and they're almost in a net long position in gold. I find that highly interesting. It means that people who are using gold in manufacturing and for investment are going long, and if they eclipse the producers, that will be historic, because I rarely, if ever, see that. Producer merchant and the precious metals are typically net short. They're not net long right now, but they're working that way. And this is a huge 1 week change of 5,000 net contracts to the long side for producer merchants. This is one, guys, we need to watch. This is really, really big. The sharp money, or the smarties, or the sharps, the swap dealers and the bullion banks, dropped 1,975 in gold short and went long 2,703 for a net change of about 4,800, meaning they're going to the long side. I always follow what they do. The managed money is going net short big time. They took on an additional 11,762 short contracts in gold. I think they're going to be the dupes in the gold trade, because I think gold is going up. They also net short, and they dropped 1,300 longs for a net short movement of about 13,000 contracts. So while the swap dealers were going more long to the tune of 5,000 contracts, and the producer merchants were going net long to the tune of 5,000 contracts, you see here and here, the managed money took the opposite side of that and went net short about 13,000 contracts, covering everybody else's long moving cord, including the other reportables, which is the family offices and wealthy individuals, went net long about 4,000 contracts. So managed money's taking it on the chin here. I think we'll have an upside movement in gold. They're going to lose money if my thoughts on that are correct. Moving over to London, the gold has stayed relatively the same. The silver's come way down. And so silver's being run off of the London market. Of course, you can see that when you go over to this chart here. This is the 4 week trend of the London market on 𝙂𝙊𝙇𝙍 site. If you go to the straight to the LBMA, you get basically the same thing. Now, some of this silver is pledged to the ETS and it's pledged to other contracts, and not all of this is liquid. This is just what they have. This is not a differentiation of what is liquid. What is liquid is expected to be much less, because you have to take this number and subtract out the majority of these numbers to get what's actually liquid. So the liquidity is a lot less. And I think that it's interesting that London, there's a runoff on that market as well. I've actually downloaded the London data, and what I'm going to do with that is graph it out for you on the next show and show you over the last few years what's happened in an Excel graph, so you can actually see a longer term on the London market as well. I think it matters, because you're going to see how there was a nice buildup, and then there was silver squeeze, and then a bit of a buildup, and then boom, it's fallen off. So buildup of inventories in London, silver squeeze, a little bit of a buildup, and then the physical buyers in London have increased, and more has come off than what came off in silver squeeze. I'll show you that chart next time we do it. Stay tuned, because we're going to do this every week and tell you what's going on in the economy. This will give you 10 to 12 to 15 minutes. Bite-sized chunk, you know what's going on in the precious metals, what's going on in the economy, what to follow, what to pay attention to. We'll do this every week. Thank you guys so much for tuning in. We'll be with you next week for the next weekly market wrap-up report.
Searching for the best precious metals deal? Shop with our trusted partner, 𝙗𝙃 Silver. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everyone, this is Robert with Gold Silver Pros, back with Ian Everard, our good friend with 𝙗𝙃 Silver, to give the weekly metals update where he tells you what's going on in the physical side of the industry, because that's what he does with 𝙗𝙃 Silver. He delivers gold and silver to you. Ian, how are you doing today?
I'm good, thank you, Rob. Good to see you safely back from your journey.
Out to the West Coast, yes. A lot of fun going out to the West Coast. Kind of expensive these days. Hard to find a hotel or a place to stay now. I hear from the locals that due to the lack of building inventory, people are renting everything in sight. I did find a little Airbnb and a little place to stay. It did take some work. But yeah, it was a nice little R&R on the left coast, and glad to be back. So how is it where you are? I heard maybe it's snowing already.
Yeah, it started to snow. We had a few false starts and then it melted, but now it looks like winter begins in Teton Valley. Yeah.
Awesome. It's begun. It's raining, as we record this outside now. Hopefully we don't lose power. That kind of happens sometimes, but we'll make it through. So Ian, I heard a story yesterday for somebody I trust, and I can't credit it because it was third-party information, although I have no reason to distrust it. And I think I was telling you this before we came on the program. Sunshine, which used to exclusively provide blanks for the U.S. Mint to do American Eagles and all of their silver issuances, decided, to expand and go sell to the markets, better, pricing terms and a little bit more demand. And I heard that they're out. So one of the reasons which U.S. Mint is not producing a lot of Eagles right now is because their supply had been run dry, because their supplier basically was feeding it to the retail end of the market, or feeding it to other, private mints and things to produce coins and bars. Does that surprise you at all, Ian? Is that, one of the stories behind why the American Eagles are so tight in supply and why the premiums are so high? And does that surprise you at all?
No, I mean, from what I understand, the Sunshine Mint was the supplier, not only for the US Mint, but for the Royal Mint, for the Britannias, and for the South African Silver Krugerrand. And the US Mint is tied to a maximum price they can pay for a blank, which is not doesn't support the costs to manufacture. And if Sunshine can make their own product or other product and get more, that's what they'll prioritize. And the legislation that the US Mint was supposed to make as many American Silver Eagles as the US population wanted to buy, and that was changed to at the discretion of the US Treasury Secretary, and we all know who she is. Mm-hmm. So I wouldn't be surprised if she says the American people need 10, not 10 million or 100 million. Yeah, we'll make 10 this year. So yeah, a lot of people's focus is on the American Silver Eagle. It's habit for a lot of people to collect them, but unfortunately, their shortage has pulled up the prices of all the other government coins.
What else is going on in the market in terms of what you're seeing? Are you seeing a lot of people still buying? Is it a robust market? Are people selling? Kind of what's going on at your level? What are people doing?
No one's selling, everyone's buying. New entrants coming in, and some of the new entrants are going straight to the 1,000-ounce bars. I've been able to, and other dealers been able to allay their concerns. Well, what do you do with this 1,000-ounce bar? Now, silverback precious metals will process a 1,000-ounce bar for you into smaller product. We're about to start slicing the bars. We're seriously looking at setting up a casting facility so we can make cast bars. So yeah, a lot of new entrants and buying heavily. A lot of people very concerned about stockbroker accounts. They've gone to cash. Now they're concerned about the cash in their brokers' accounts. Is it theirs? And I think a lot of people come to the conclusion, if you don't hold it, you don't own it.
Yeah, and certainly with physical assets are concerned, that is true. I want to turn to some macroeconomic news, specifically around the Fed. We like to talk about this on the program. The Fed has come out and said they have a new interest rate target of 5%. I believe that was always their target, but they can't come out and tell the market when they're at 0.25, they're going to go to 5. It will freak everybody out. So they've been conditioning people as they go along, raising the target. And that wasn't seen as great news, especially with the 0.75 point hikes are going to continue. The one thing the Fed did say, however, is they're watching the market, and they could use their policy tools if anything breaks. Powell did mention that last year. A year later, they're talking about it again. Is the Fed pivoting here, or are they just trying to keep people from panicking as they continually get tight and raise their targets for interest rates every time basically they have a press conference?
Well, they're always lying to us one way or another. They're either outright lying, and then they do the opposite. I mean, we've mentioned before last year, did Jerome, the wonderful Jerome, say, "I see no inflation. I don't expect any interest rate rises in 2022." So they're either outright lying or they're telling the truth, but we think they're lying, so we still get lied to. And personally, I'm taking less and less. I mean, yes, we need to know the side effects of their decisions, and the market's obviously always trying to front run and get ahead of the decisions. But with what's coming and the destruction of fiat currencies, it's best just to concentrate on the big picture. You know, unless you're day trading in and out and you're very nimble and you've got lots of things going on, the big picture is fiat currencies die. They always have done, they always will do. Our wonderful dollar, and it is rather wonderful at the moment for Americans who have got spare dollars, is dying.
Yeah, I think it is. And I wonder if what's going on in the UK may be a preview of what may come to the US. So the UK, we may have talked last time about the shortest prime minister in history. I think it was 44 or 45 days because of some tax breaks they're given, blew up in their face. A new guy comes in, Goldman Sachs guy. Looks like he's going to propel the UK to central bank digital currencies if his past is any sort of indicator. And then I read yesterday that the Bank of England came out and said and warned the British people, prepare for the longest recession in our history. The longest recession in our history. Ian, yeah. How could they know that? What exactly is going on across the pond, do you think?
They know because they know the consequences of currency debasement. Mm-hmm. They know the consequences, and they've had their hands in they've had their snouts in the trough feeding on fees. The people at the top of the food chain get their first access to the free money, the new extra currency created, and that's the Richard Cantillon effect. That has the new currency has value for the people who get it first. The time this all filters through, real stuff needs more units of currency. So yeah, I think, I mean, lots of people, Nomi Prince is talking about the biggest shift ever, you know, a transfer of $150 trillion of wealth. So yeah, everything is going to change. We're going to just have to get real, work out what's important and what we need, and keep crossing off the things that we want to leave enough room for the things we need. And that's going to be hard for some people. But there's still plenty of Americans who got room, they've got time to get comfortably protected for what's coming.
Yeah, I think I agree with you there. Anything else in the news that's happened recently that caught your interest? Anything that you see that people should be considering?
Yeah, absolutely. From what I understand, the BIS, the Bank of International Settlements, so the central bank for central banks, these are the guys that tell all the central banks what they can and can't do and when to do it, typically don't let gold rise more than 2% in one day. Well, it rose 2.75%, 2.77%. So either they're letting it break that amount, and traditionally they would stop it when the paper manipulation wasn't enough. They would sell physical gold, maybe 100 tons or more, just to damp things down. So either they've tried it and it failed, or they've given up and they're going to let it run. And then we got also, it was the BIS who did the naming gold as a tier 1 asset alongside US debt. Mm-hmm. You know, I think what would you rather own, Rob? US debt or gold?
I'd rather have gold. Because you look at the bond market right now, and I think people are freaking out. If you look at the technical indicators on the bond market, half the bond market thinks the rate should go up. The other half thinks it should go down on the 10-year. They don't even know what's coming. And they're some of the smartest analysts and traders out there because they have to be. I mean, you're putting money into debt over the long term. You watch what goes on. But that bond market, I see a bifurcation or a split there, Ian. You can see it in the technical charts. Half the people want it to ride higher interest rates. The other half people think it's gonna come back down. And that, to me, calls into question whether bonds are truly a safe haven anymore. It seems like half of the bond market edging away, saying, I want to get rid of these because, we're not liking where the interest rates are going here.
Yeah, I think human action will take over. And then the Federal Reserve will be irrelevant because it won't matter what they say or don't say, what they do or don't do. When a small amount of the population, maybe 10 or 15 or 20%, realize they do not want to hold dollars, they want to buy forward consumption and buy it now. They want to buy spare diesel, they want to buy a spare truck, they want to buy spare clothes, spare food, spare consumables. When we get a move into that, human action takes over, and it does not matter what a central bank does. It really, that the game is over for the currency. Then when people lose all trust that it's a store of value, and if you sort of pause and just look at history, I mean, from 1913, the dollar's lost 98% of its purchasing power. But I often say to people, the 2% that's left is our 100%. That 2% can lose 100% of its purchasing power.
That's right.
And will. So human action will take over. I mean, it doesn't matter what the government or the central bank does, the currency dies, and people will choose individually and in their own communities what is money. And people will realize it has to be a store of value.
I agree with you. I think anything physical that has intrinsic value in and of itself will probably maintain at least some of that, if not all that intrinsic value going forward. Gold and silver probably at the head of that class because they've been money. Like you said, gold is in the Basel III standards. Silver is required for everything that's produced. Both of those have really good cases for staying relevant for the next 100 years, I would think. Turning back to the bullion for a second, Ian, what do you recommend? What are people buying right now? What do you have for people?
Well, if you can afford a 1,000-ounce bar, get one whilst you can.
Okay.
You can then get it. You can send it to myself or Silverback to get it processed into 10-ounce bars, 5-ounce bars in the future, or you can just hold it. Then the next best value still is a 40% constitutional, our own 10-ounce ARK bars. Because they're made from the 1,000-ounce bars, we're not held hostage to the wholesalers putting the premiums up. But at the end of the day, I've said it many times, and I'll keep saying it till silver is $50. If you can get silver for below $50, you will look back and you'll say, "Oh my gosh, it was free. Why didn't I get more of it?"
Yeah, I agree with you there. Okay, thank you so much, Ian. That'll wrap it up for this weekly metals update. How do people get in contact with you if they're interested maybe in getting some product?
Yeah, we are 𝙎𝙀𝙇𝙀𝙍. You can get to us through Gold Silver Pro's website, or you can pull up my phone number from our website.
Okay, perfect. Thank you so much, Ian, for coming on the show, especially on short notice. I know it's a busy Friday, but appreciate you coming on. It really does help, I think, the viewers understand what's going on. And we want you on every week to tell what's going on in the physical market, because as I've always said, the physical market tells you the story in precious metals, not the derivative markets. Don't pay attention to that spot price. I know it's what everybody wants to look at. It's the ticker, but that's not what's going on with the market. It's always the physical, and the value you come in on the show every week is providing that from a boots on the ground perspective, because that's what you do every day. Thank you so much for joining in. We'll see you next week.
You're welcome. Thank you, Rob.